A company once grew faster than almost any modern business anyone had ever witnessed. It reached a $1 billion valuation in less than 16 astonishing months. At its peak, the world believed this platform represented the future of local commerce. Today, that same company trades at a tiny fraction of its former glory. This is the dramatic rise and painful fall of the company known as Groupon. The story begins in the city of Chicago during the uncertain months of late 2008. The global financial system was shaking and fear dominated headlines everywhere. During this chaos, a young music major named Andrew Mason explored a strange idea. He believed the internet could help people organize around shared social causes. Mason launched a website called The Point to support collective group action. The platform allowed people to pledge support toward goals, requiring mass participation. Despite the creativity, the website struggled to attract users or generate revenue. Growth was slow, and enthusiasm from investors remained extremely limited. However, Mason noticed something unusual about how users interacted with the platform. Most visitors were not organizing causes but experimenting with group purchasing behavior. They wanted discounts by committing to buy products together. This observation sparked a critical pivot that would change everything. Mason decided to abandon activism and focus entirely on group-based discounts. He launched a new website called Groupon, combining group purchasing and coupons. The concept was incredibly simple and immediately easy to understand. Each day, Groupon offered a single discounted deal from a local business. Customers could purchase services like meals, spa treatments, or fitness classes cheaply. A typical deal offered 50% savings compared to regular prices. However, each deal came with a powerful and clever condition. The discount only activated if enough people purchased the deal together. If the minimum threshold failed, the deal disappeared for everyone. This condition created urgency and encouraged aggressive social sharing. Users began emailing, texting, and posting deals to friends constantly. Every purchase felt like a small social mission with a clear reward. Growth exploded faster than almost any previous internet business. Within months, Groupon expanded to dozens of major American cities. Within 2 years, Groupon operated across hundreds of global locations. The company hired thousands of aggressive sales representatives worldwide. These sales teams convinced local businesses to offer daily deals continuously. Revenue appeared to grow by thousands of % throughout 2010. Media outlets praised Groupon as a once-in-a-generation technology phenomenon. Forbes labeled Groupon the fastest-growing company in modern business history. Behind the scenes, however, a dangerous flaw quietly expanded every month. The platform's explosive growth depended entirely on local small businesses. These merchants were the true backbone of Groupon's daily deals ecosystem. Unfortunately, many merchants soon realized the deals were financially damaging. Consider a small restaurant with limited seating and thin profit margins. A Groupon deal could suddenly bring hundreds of discount-seeking customers. The restaurant earned far less revenue per customer than usual. Staff became overwhelmed and service quality often declined rapidly. Regular customers avoided the chaos and stopped visiting entirely. Many businesses lost money on every Groupon redemption processed. Owners hoped discounted customers would return and pay full price later. However, most Groupon users chased discounts rather than brand loyalty. They rarely returned without another deal incentive. This behavior created high churn and little long-term value for merchants. Despite warnings, Groupon leadership largely dismissed these merchant complaints. Executives focused on growth metrics instead of sustainable partner success. As dissatisfaction grew, many quality merchants quietly abandoned the platform. This erosion weakened the foundation supporting Groupon's massive expansion. Meanwhile, powerful technology giants started paying close attention. Google recognized Groupon's influence and growing user base early. In 2010, Google offered to acquire Groupon for $6 billion. The offer came entirely in cash and stunned the technology industry. Many advisors urged Andrew Mason to accept the historic offer. For a young startup, the deal represented extraordinary validation and security. Mason believed Groupon's potential far exceeded the offer's valuation. He envisioned a global local commerce empire dominating daily consumer behavior. Confident in future growth, Mason rejected Google's acquisition proposal. This decision later became one of Silicon Valley's most debated choices. Following the rejection, Groupon accelerated plans for a public stock offering. By 2011, the company prepared aggressively for its initial public offering. However, investors began noticing concerning details inside financial disclosures. Groupon used an unusual metric called Adjusted Consolidated Segment Operating Income. This metric excluded critical costs associated with customer acquisition. Marketing expenses were enormous but largely hidden from profitability calculations. As a result, the business appeared far more profitable than reality. Financial analysts questioned the transparency and accuracy of these reports. Regulatory agencies eventually intervened and demanded clearer accounting practices. Groupon was forced to restate earnings using more conventional standards. This movement severely damaged trust with institutional investors. Despite concerns, the IPO proceeded amid intense public excitement. On its first trading day, Groupon achieved a valuation near $13 billion. For a brief period, Mason appeared justified in rejecting Google's offer. However, cracks in the business model widened rapidly after the IPO. Competition exploded as copycat deal websites flooded global markets. Living Social emerged as Groupon's strongest competitor, backed by Amazon. Marketing costs soared as platforms fought aggressively for user attention. Profit margins shrank as discounts grew deeper and less sustainable. Merchants demanded better terms or abandoned deal platforms entirely. Deal quality declined as top-tier businesses exited the ecosystem. Consumers began receiving repetitive and uninspiring email offers daily. What once felt exciting now resembled unwanted digital clutter. Open rates dropped and engagement steadily declined across regions. Stock prices reflected growing doubts about long-term viability. By early 2013, Groupon's valuation had collapsed dramatically. Shares fell nearly 80% from their IPO peak. The board of directors ultimately decided leadership changes were necessary. Andrew Mason was officially removed as chief executive officer. Mason published a candid and humorous farewell letter afterward. He acknowledged failure to meet ambitious expectations set earlier. The departure marked the symbolic end of Groupon's meteoric phase. New leadership attempted to stabilize operations and rebuild credibility. Groupon explored diversification beyond local service discounts. The company launched an online marketplace selling physical products. Electronics, home goods, and accessories entered the Groupon catalog. Unfortunately, this strategy placed Groupon against dominant e-commerce giants. Amazon's scale, logistics, and pricing power proved impossible to match. The marketplace experiment failed to restore meaningful growth. Meanwhile, Groupon's original identity continued fading away. Local discovery was no longer unique or differentiated. Mobile apps offered location-based recommendations without heavy discounts. Social platforms introduced native deal-sharing features seamlessly. Groupon struggled to articulate its value proposition clearly. Revenue declined steadily as operating costs remained stubbornly high. International operations were sold or shut down to conserve resources. Employee morale suffered amid repeated restructurings and layoffs. Public perception shifted from innovator to cautionary tale. Today, Groupon still operates but commands little cultural relevance. Its market valuation remains below $1 billion. The platform serves fewer users and fewer merchants than before. Its once famous daily deal emails attract limited attention. The Groupon story offers powerful lessons for modern entrepreneurs. Rapid growth cannot replace sustainable unit economics. Partners must benefit meaningfully for platforms to survive long-term. Short-term hype often masks deep structural weaknesses. Accounting transparency is essential for maintaining investor trust. User growth without loyalty creates fragile businesses. Competition intensifies quickly when barriers to entry remain low. Timing matters, especially when rejecting life-changing acquisition offers. Success requires patience, discipline, and balanced incentives. Groupon achieved scale faster than operational maturity allowed. That imbalance ultimately undermined everything built so quickly. The company's rise shows the power of simple viral ideas. Its fall highlights the cost of ignoring foundational economics. Every startup dreams of explosive growth and global attention. Few survive the consequences without careful planning and humility. Groupon remains a lasting reminder that growth alone is never enough.